And now, the senior vice president of the New York Stock Exchange on globalization, emerging economies, and stock markets. This is from Thursday at the Federal Reserve Bank of Philadelphia. It's about 55 minutes.
Is not an economist. Economists can't tell you anything about whether the stock market's going up or down tomorrow, and they make a big deal about that. So I'm not going to be talking about that aspect of tomorrow's stock markets. What I really wanted to talk about today was there's been anybody who reads the paper can see that the stock exchange and the stock market business is really in quite a lot of flux, and I really wanted to talk about what's going on because I think the model of a stock exchange that you see every day with people running around on the floor is really increasingly that's only part of the story. And that the stock exchanges that are going to be of the future, which is starting to be now, are really are going to be somewhat different from that. And I think basically that will be to the advantage of investors and anybody else who has an interest in the markets. So let's see if I can make this work. Okay. Just as an outline, I think the major forces, one of the really important forces is the whole automation, because everything's becoming automated, as you know, in our lives, and stock exchanges and stock trading is no different from that. And it's come a long way, and it's going to go a lot further. So I think we talk about automation, consolidation, globalization, and what I call multi-product economies of scope. By automation is just basically that computerization has lowered the cost of trading and made it much, much faster. And that in turn has implications, which I'll talk about a little bit. And this is related to all what we see in the paper, all the consolidations and mergers that's going on. And the globalization and the computerization in turn generates economies of scale. Which, in other words, that you can do things on a much larger scale and maybe at a lower cost than before, and also similarly, so-called economies of scope, which I guess in layman's talk is something similar to what we might call synergies or something, where you can do a lot of different products together and get benefits from them. So it's not just stocks anymore. The NYSE Euronext trades in a lot of different products, and I think that's sort of the wave of the future. So let me just talk about automation, cost, and speed. This just reviews some of the most recent trends. Now, what's plotted there is for the last 5 years or so. It's a measure of execution costs that's put together by a group called Plexus, which has been monitoring execution costs by going and talking to money managers and figuring out how much it actually costs them to trade. And they have a very complicated and elaborate way of figuring out how much it really costs to trade. It's not just how much you pay in fees, but it's also what your market, the impact of your order is, and if you want to buy a lot of stock, did you drive the price up? If you want to sell a lot of stock, did you drive the price down? And what you see in this picture is just that it's becoming a lot cheaper to buy and sell stock than it used to be. And basically, I would say the main reason this is because of automation. Automation not only reduces the cost, you don't have to have as many people involved in the process. You can have all the record keeping and transactions. In addition, all the back office stuff is increasingly automated, but also you can get a lot of different kinds of complicated computerized trading strategies, and the net of the whole thing is that it lowers the cost. So you see, in terms of both, the red line there is for NASDAQ stocks, and the blue line is for NYSE stocks, and you see that in the U.S. there's been very dramatic drops in the cost of trading, and as far as I can tell, that's still a process that's underway. The other thing is that it's so much faster to trade now. Now, what this is the I'm going to step over here for a second. That this is the scale here is how many seconds it takes once an order is received by a stock exchange for the order to be executed. Now, and this is limited just to orders that are intended to be executed automatically, not the orders that are going to be handled by a broker running around the floor trying to find someone with them. But these are just the orders that go into the computer and then they're automatically turned around. And what you see is that it used to take 1.5 seconds or 2 seconds to execute a stock trade, and now there's so much computer processing power and the systems have become so efficient that it's just a matter of relatively few milliseconds to trade now. And in fact, the stock exchanges now are competing to see who can execute trades faster and faster. So the point, I think, the big picture here is just that the equities business is becoming so automated, and the competition, and it's not just a question of, gee, eliminating some people, by automating. It's more that even the computers are competing against each other to be faster and faster, because everybody wants to send in their stock order to the place where they're going to get executed before the next guy. So it's a very interesting set of competition that's been put into place here. So stock trading has become not only cheaper, but it's also much faster. So then the question is, what's the relationship between this and the consolidation, all the mergers? There's been so much in the paper, as I mentioned. We see that the NYSE has merged with ARCA, which is an all-electronic stock exchange. I might have mentioned that what used to be part of the Pacific Stock Exchange. And then the Paris, Amsterdam, Brussels, and Lisbon, and the London International Financial Futures Market merged and became Euronext a few years ago. And Alternext is a platform that they have in addition to the other platforms, and that's for trading very small companies. And then that's all been merged together with NYSE and ARCA, so that you're seeing this big agglomeration of stock exchanges. Now, these are still all separate companies to a large extent, but more and more they're trading on the same platforms, taking advantage of common technology. They're still going to be regulated a little bit differently by their national regulators, but the businesses are clearly merging, and that seems to be the future. Now, in the U.S., we've had the Chicago Mercantile Exchange and the Chicago Board of Trade have just recently merged, and those are the two biggest futures trading platforms in the U.S. In Europe, the London Stock Exchange has just recently agreed to a merger with the Borsa d'Italia, the Italian stock exchange, which, by the way, in turn was a merger of all the local stock exchanges in Italy. And the Deutsche Börse, which is the big German stock exchange, has done a merger with the ISE, which, if you're not familiar, is it's called the International Securities Exchange. It's really probably one of the largest single all electronic options platforms in the U.S. So again, it's a merger of two exchanges that are very powerful in their fields. So all of this is going on now. You probably more recently, you know that the Philadelphia Stock Exchange, I'm reading in the paper, has agreed to merge with NASDAQ, which has also merged with or at least reached an agreement to merge with the Boston Stock Exchange, and also is, as I understand it, is also I don't know if the deal is. I don't believe the deal is complete yet, but is also negotiating with the Scandinavian stock exchanges, OMX, which in turn is an alliance of several of the Nordic country stock exchanges. So there's this whole agglomeration going on around the world. So it's this interesting process where the automation, because you can get a really good trading system, and then you can multiply it as a technology. If you had to, if you took the old New York Stock Exchange, back, say, a few decades ago, there was a time, if you went back, say, to the 19th century, all the trading on the New York Stock Exchange, of course, was completely manual. It was all, everything had to be done by hand. Everything was negotiated. And most of the trading in the 19th century, by the way, was in bonds. When the equities started to become popular at the end of the 19th century and into the 20th century, they became a much more profitable thing to trade, and the bonds gradually got pushed off the floor. So there wasn't literally enough room, as more and more equities, the bonds sort of got marginalized, and eventually the New York Stock Exchange stopped being the real center of bond trading in New York. But that's because to trade you had to have a physical presence. So the NYSE, gradually became a company that just focused on equities, and people sort of in their minds identify with equities. But if you can see now, these mergers, it allows stock exchanges to trade, all different kinds of products. And I think, for example, so the Deutsche Börse and the ISE is one example of that. I'll say a little bit more about it later, but it's changing the idea. Even when we say stock exchanges, I think increasingly we're going to mean something much more generic than just corporate equities. Okay, let's see. Okay, economies of scale. This is economists' talk for what do we mean by economies of scale? We just mean it's cheaper to do something on a larger scale, that the unit cost goes down. Maybe you have some fixed costs, and you spread it over more and more when your volume increases. Now, if you think about it, some people say, well, why are stock exchanges going global, one way of understanding it, to me, is that I think about, who are our customers and who are the people who participate in the stock exchange business, and in some sense, those are our customers. So the listed companies are probably our most important customer in some way, because those are the companies that list their stocks on the NYSE, and in some ultimate way where they are our raison d'etre. So listed companies have been global, for as long as almost as long as the stock exchange has been in existence. Listed companies have been, doing business around the world, and of course, as during the 19th and 20th centuries, this became, a much more important activity. So a lot of the household names are not in the U.S. Of course, we have Japanese, German, British companies from all around the world are doing business here, and similarly with U.S. companies all around the world. So globalization in the world of business is just, it's something we just take for granted. Investors also, probably 20 years ago, it was a little bit less common for U.S. investors to hold a lot of foreign stocks or a lot of foreign investors, of a lot of foreign investments. But nowadays, of course, everyone knows, you talk to your financial advisor, you go to your mutual fund company, and it's almost, you're required to buy foreign stocks, or else, there's something wrong with you, right? And in fact, the economists will all tell you that to be properly diversified, for a given rate of return, you really need to own foreign stocks in your portfolio. So this is kind of becoming commonplace. So the whole investment process and this has been going on for a long time, but it's really accelerated. Now, banking, of course, has been international for decades as well, but it became a lot more international since the World War II. And of course, we all remember the ups and downs of global banking as U.S. banks, expanded into Latin America or into Asia, and you have these intermittent times when they were making a lot of money or losing a lot of money on the loans and the activities there. But certainly, especially in terms of not only in terms of commercial banking, but in underwriting and all other kinds of activities that banks are involved with, the world has been clearly becoming globalized. Traders. As soon as you have people own stocks around the world, people want to trade them. So the trading activity, the hedge funds are all involved in trading in different markets all around the world as well. So it only makes sense in some ways that these exchanges, which are providing a basic service to trading and to listed companies, should also be become global. And so that's sort of the way I'm thinking about why stock exchanges are becoming cross-border institutions now. They're still very much viewed as, from the point of view of a community, or as national institutions in many ways. But from a business viewpoint, they really have to think that they're international organizations, and because that's the way our customers want to do business. So I think that's the shorthand way of understanding why we're expanding this way. Now, the other way of looking at it is to just look at a few facts. If you look at the value of stocks that are being held across border, this is data that is actually created by the Federal Reserve. Thank you very much. It's the so-called flow of funds data that shows the amount of equities that are being, the blue bar is the value of equities of equities in non-U.S. companies that are held by Americans, and the green part is the amount of U.S. stocks that are held by non-U.S. residents. So it's sort of a measure of the amount of cross-border outstanding equity positions. And as you can see, you know, since 1997 to the middle of this year, when the data go, you know, there was an increase after the year 2000. There was a little slump, and then it started to go. But you know, it's just taken off. The amount of holdings of cross-border equities is just continues to rise like crazy. So there's clearly a big trend here. Similarly, but that's the outstanding amount. What this is this shows the amount of trading. This is a kind of a proxy for the amount of trading, because this shows for foreign companies that are listed on the New York Stock Exchange how much turnover is there, what's the volume. And it just shows you that, you know, even at the peak in the year 2000, we were talking about $4.5 billion on a daily basis. Now it's up 9, and it's probably approaching $10 billion a day of trading in non-U.S. stocks. Now there's also going to be money managers in the U.S. are also using, you know, modern communications can go and purchase stocks directly into the foreign countries themselves. They don't have to buy a foreign security on the New York Stock Exchange. They could go to the stock exchange in Warsaw, or the stock exchange in Japan, wherever, and buy the stock directly through a broker there. So that's the alternative way. But I think all of those charts, if you got them, would all sort of look the same. They'd all be going up, just like the outstanding. So that really what's driving this globalization business in a most fundamental way is just our customers, what's going on in terms of the demand for our services. This also shows, this is the this is as of September of 2007. It shows the value of IPOs, initial public offerings that are being done around the world. The blue is the U.S., Brazil, and so basically this is the Western Hemisphere. This is Asia, Asia Pacific, and then this is the rest of Europe. This is Russia, UK, and the rest of Europe, and also the Middle East in there. So basically you can see that there's so much business to be done around the world in terms of initial public offering activity that's another reason why, of course, why all the money managers and everybody very interested in this, and another reason why the stock exchange needs to be a global organization. Now, there's another twist to this, which is if I'm a corporation, why would I want to list my stock in more than one stock exchange? Because that's the other thing that's going on. It's not just that the stock exchanges are expanding into the different countries, but U.S. non-U.S. corporations, for example, are listing their stocks in the U.S. U.S. companies are listing their stocks elsewhere. There's all this, cross-border listing that's going on. Companies are listing their stocks in London. I'd say probably the biggest activity is probably, in value terms, is probably non-U.S. companies listing in the United States on either, probably the NYSE is probably the biggest, and then NASDAQ, and in terms of dollars. And then the other big platform, which is the London Stock Exchange, which because Europe is a lot of different countries, so that a lot of the intra-European stuff counts as listing cross-border. But now this shows, what this chart is it's actually a chart that was based on data that was done by a couple of economists that are doing research at Ohio State University and one at the University of Toronto. And what they've done is they've said, and the question is that they're trying to answer is, why would a company want to list in the U.S.? And the answer that a lot of people think is, gee, it's because, I want to be able to trade in the U.S. But there's something much more important that's going on. And this is sort of what's the other thing that's driving this sort of globalization of the equities markets. And that is that you're trying to appeal to investors around the world. But investors around the world are what they need is good information. They want to make sure that the statements that you're putting out are accurate. They want to make sure that you're adhering to sort of the highest possible standards of corporate governance, of reporting, and so forth. So for all of the questions that have arisen in the United States in the last 5 or 10 years about corporate governance and control issues and regulatory issues, the U.S. is still regarded as having some of the strongest standards for company registrations and listings and reporting in the world. So what this study does is it says, okay, let's just do the following thought experiment. Take two companies in whatever country you want to talk about, but outside of the U.S. One of them, and you're trying to control statistically for how fast they're growing, other kinds of variables. And in some ways, it doesn't matter what you control for; you get the same answer. And you try to do as many careful statistical controls as you can, and you basically say, just here's a pair of companies. One of them lists in the U.S., the other one doesn't. And what you find is, and what these studies find is that the companies that list in the U.S. have a significantly higher valuation. And the reason that the authors give is that because people have gone through the process of registering and disclosure and adhering to the standards that are required by the SEC, the NYSE, the NASDAQ, whatever exchange they're listed on. And you see that it really helps their valuation quite a lot. A lot more investors will then consider seriously buying this stock and take positions in those stocks. So this is just, if you look at all cross-listed stocks, which includes some that are not listed on an exchange, but are just registered in the U.S., and then this is going to be those that are actually exchange listed and also have to adhere to the standards of U.S. stock exchanges. And what you see is that the red portion is sort of the premium that the companies get for listing in the U.S. So this is a kind of a long-winded way of saying that one of the reasons that companies, particularly large companies that are seeking a broad investor base and so forth, they want to list in different economies because if they adhere to the standards that people are comfortable with in those economies, that they'll attract a lot more investors. And in addition to that, the U.S. is viewed as having, and we should be very proud of this, that the U.S. is viewed as having, really some of the highest standards in the world, and it really does help a non-U.S. company's stock price to list here. So that's another important driving force, and there's been a lot of talk in Washington and the press about this issue directly or indirectly, but this is like a very important fact. And as you can see, the premium, has stayed there. It's not something we've lost since the Sarbanes-Oxley or anything like that. If anything, it's just as strong as ever. Okay, now people sometimes ask, well, getting back to the question of stock exchanges themselves, what are the economies of scale? Well, anytime something is computerized and has a whole set of communications links and so forth, you get what you might call network externalities. Suddenly, you have not only the people on the trading floor, but you have people all around the world are connected, and they can trade a stock. And so you get a lot more liquidity. You can create, you get a bigger market, so you can create better products. If you have an exchange-traded fund, I was talking to someone who trades exchange-traded funds, and that you can create a critical mass for a market in these instruments. In some ways, what our stock exchanges are becoming is they're becoming a network, with a lot of different services attached to them. So then, and the more people participate, then the more liquidity there is, the more and the better the price discovery is. The prices are going to reflect a lot more information, and you're going to have people that are willing to trade at those prices. In terms of data processing and communications, as we all know, the cost of computer processing power is going down and down and down. So you can have a fairly economical computer department, and you can, in theory, you could operate a stock exchange on a global basis. That's a little bit of an overstatement. I'm an economist. I don't really understand how computers work particularly well, but I do know that as these stock exchanges merge, what you see is that the data centers start to consolidate. You don't want to have everything in one data center because it creates too many operational vulnerabilities, but you don't need, 8 or 10 data centers, so you can start to save a lot of money very fast. And at the same time, you can, using modern data processing and systems development, each market can still have its own specific front-end features so that these can adhere to the regulatory standards in each country or market, because each country still has a responsibility of protecting its shareholders. So you will have, in some ways it'll look like it's the stock exchange that has been tailored for the brokerage community or the investor community for each particular country. But behind all that, you can still achieve tremendous economies of scale on a technological basis, even while you're merging these stock exchanges. So it can keep the investors and the brokers and regulators can have a certain level of comfort with what you're doing. It doesn't have to be like you come in and impose one huge new way of trading on the world. It doesn't work that way. It's more that you can take how trading has been happening in a country, and you can support it with a global infrastructure. So as we become a multi-product exchange, now as you noticed, I mentioned that NASDAQ had merged with the Philadelphia Stock Exchange, and those of you who are from Philadelphia, which is almost everyone here, I guess, probably know the Philadelphia Stock Exchange's main product is trading stock options and other kinds of options. So it's already a derivatives exchange. And similarly, that process is expanding very rapidly, where exchanges are trading a lot of different products. So on the NYSE Euronext, and I think you'll see this on more of these sort of global exchanges, they'll trade futures and options. They'll trade equities, stocks. They'll also trade bonds, fixed income. They'll trade ETFs, which can be, which can contain, exchange-traded funds can contain, different combinations of these types of assets. And at the same time, so you can have the same, you can have a similar front end, you can have a similar computer infrastructure, and it can support trading in all of these. Now, the speed in the trading strategies works into this because a lot of trading strategies, as you know, involve multiple instruments. So that instead of calling up one broker and saying, gee, I want to, buy the bond and then I want to short the stock or whatever your trading strategy is, you can, in principle, and this is going forward a little bit, you can in theory do this stuff, electronically all on one platform through one stock exchange. This is not, haven't described the way things are right now. Things are still a little bit more segmented than that, but I think going forward, this in fact will be the case. I just don't know how many years we're talking about, but I think it's definitely on the horizon. So right now, as I mentioned before, the equity trading platforms where people are are competing to get to millisecond executions and so forth. If you expanded that and you thought, well, gee, if I could execute a position electronically, if I could buy the futures and sell the stocks and all this in milliseconds in the same way, it would really change trading a lot. If to be able to do that with bonds and futures and so forth, all in the same instant. Right now, to do that, you have to do it through a dealer, someone who will take your position and then trade it later. But to be able to do that either as a customer or as a dealer, to be able to do that directly with the exchange, you're going to get a lot more liquidity. And so I think you're going to see a lot more interesting trading opportunities going forward. Okay, and here I don't want to look like I'm touting any one exchange or platform unduly, but I thought an interesting example is the NYSE Arca, which, as I said, it used to be, it was Archipelago was the original so-called ECN or electronic trading platform for equities. Then they merged with the Pacific Stock Exchange and became a full-blown stock exchange. Now they're a subsidiary of NYSE Euronext. And what they can do is they trade this whole array of different products. They trade the options. They have a linkage with the life. They trade fixed income. They trade exchange-traded funds. People that trade ETFs really like the Arca platform. They trade stocks. Not only do they trade NYSE stocks, but they also trade NASDAQ stocks, and they have their own listing because it was a Pacific Stock Exchange before, so you can actually list. There are a number of companies that are smaller companies that are actually listed. Their primary listing is on the Arca platform, and then ADRs in terms of ADRs is American Depository Receipts. This is how non-U.S. stocks are traded in the U.S. So basically, you're getting this huge array of different assets that are all trading on this one platform. So I think that this is a kind of a microcosm that suggests how things can be going forward. Let's see now. So anyway, I will wrap it up here. I think just to summarize, I think that this automation is connected with the globalization. In other words, it generates the economies of scale. It's sort of what's behind all these mergers of stock exchanges we've been reading about. Some people have speculated that, in the world of the future, tomorrow's stock exchanges, you'll have like a few giant stock exchanges. And I would add on to that your economics tells you you'll always have new entrants. You'll always have people that specialize and can compete with the big guys because they have maybe more knowledge and more flexibility. So I think you'll have these a few giant stock exchanges, and then you'll have some smaller ones that are specialized and are maybe entering the market trying to do something better than anyone else. I think that they will be multi-product exchanges. I think we call them stock exchanges. They're going to be multi-product exchanges. And this, there's a whole raft of other issues that, you know, in terms of regulation, it's still done largely at the national level. But I think you're starting to see, for example, the SEC is certainly starting to very actively consider using other accounting methods, not just the GAAP accounting, but accepting for certain types of securities the IFRS accounting. The regulation, you're starting to see, for example, on the Euronext, they actually have a college of regulators where the regulators from the different countries come together and they try to make rules, and most of the time they don't conflict, but they just try to get it down into the same language and so that people can trade across border without problems. But basically, there's always going to be a lot of you know, national level issues and questions that have to be dealt with, and so that's why stock exchanges are still, to a large extent, national organizations. But I think you're still going to see these international agglomeration of stock exchanges that can sort of take advantage of the automation and the marketing and the branding sorts of things that we would you know, that we're becoming familiar with now. So anyway, that's my summary of my talk, and so I just wanted to open it up now to see if you had any questions. Yes, sir.
I'm in the front row.
Okay.
Stock traders, and I am not a stock trader, are interested in all kinds of data, and you're a data man as an economist. I've always been interested in the question of who owns these stocks that are being traded, these hundreds of thousands of stocks. And in an aggregate, you'll find that people have different opinions about the participation of institutional investors as opposed to private investors. And they'll give you figures on a given company and say 15% of the stock in this company is owned by individual investors and 85% by institutional investors. My question is, are there any standards for the reporting of this kind of data, as I'm sure there are on volume, daily volume and that kind of stuff, but as far as who owns the stocks, do you have standards about reporting?
The New York Stock Exchange, to my knowledge, does not, have the business, is not involved in the business of specifically saying, who owns what stocks. There are certain companies that specialize in being able to say, if I'm a CEO and I want to know who owns my company, clearly that's a very interesting question for a lot of CEOs and corporate boards and so forth. And there are companies that specialize in doing their own research and sort of figuring out who owns the equities. And partly it's going to be from public reporting, partly it's going to be from, calling around and finding out and looking at a lot of different types of reports. So piecing that together is a tricky business. The stock exchange itself doesn't do it. What we do is we will know, of course, what member firm of the stock exchange submitted an order, and we also ask members when they send orders in to indicate whether it's on behalf of a retail customer, if it's for their own position, if it's on behalf of an institutional customer, but we don't make them say who, So there was another question back there.
I was going to ask, you talked about a number of the factors that are driving consolidation.
Yes.
And I was wondering if there are some forces working the other way. Are there some natural forces at work to bound the size of exchanges or the degree to which they'll be integrated? As NSE, as the New York Stock Exchange gets bigger and bigger, do you start to feel there are some disadvantages to size or to agglomeration?
Well, I think no one knows where the optimal size of any company really is, especially when there's a lot of technical change going on. There was a time, this being the Federal Reserve Bank, there was a time when all the banks, especially when they ended interstate banking in the U.S., and banks suddenly all started to agglomerate, and a very similar set of questions came up. And everybody felt, gee, for a lot of banks, these state boundaries are artificial and limiting people's businesses. Well, then how big could you be? And one question is, do you just kind of keep growing, and then you say, gee, I'm big enough, or do you just say, gee, let's put as much together as we can and see if it's too big, and then maybe start shrinking it a little bit? So, there's different ways of figuring out what the right answer is, and you're probably shooting at a moving target. I think right now for the equities business, people understand that stock exchanges, need to become larger to achieve, based on technology and the way trading occurs now. I don't, a lot of the limits in any company of that size have to do with how well it's managed, it's really a question of execution. So, aside from that, that's all a long-winded way of saying, really, I don't really know the answer to your question. I'm not sure anybody does, but it's certainly an interesting question. Yes.
I was wondering if you might comment on the mechanical difficulties or others that could exist in, say, expanding or creating a relationship between NYSE, Euronext, and, say, the Russian stock market.
I'm not, completely familiar with how the Russian stock market works. I think they have a much more active market in, for example, government securities and so forth. I think, one of the important things for NYSE is always that if a company lists there, they have to, particularly if they list, in either one of the European exchanges or in the U.S. is that they adhere to the regulatory standards in that country. So you have, as long as you're merging with a country that, with a company from a country that, where you're very sure of the regulatory standards and how things work there, then I think it could be a plus for your brand and your reputation. One of the reasons that companies list, say Russian companies, for example, could list in London or could list in the U.S. is because most Americans or most European investors, for that matter, are kind of like me. They don't quite know the answer to your question, so they feel comfortable when the company has, in fact, registered and listed in the U.S. or in their local, with their local regulators. So I think that's a reason why, the Russian companies, for example, would list in the U.S. is because, then U.S. investors feel more sure about, what they're buying. In terms of, an alliance for the Russian stock exchange or something like that, to my knowledge, we haven't, had such conversations, and I'm not sure of anyone that has at this point, but perhaps that's something for the future. Yes. You had a question right here. Okay.
Paul, I was intrigued with that chart you had, which showed the premium available to foreign companies listing in U.S. exchanges. Right. And you made, I thought, a pretty provocative comment in suggesting that, gee whiz, look at these numbers. This is post-Sarbanes-Oxley and a number of other events that maybe have taken place in this country. At the same time, we have some dialogue in a variety of places that suggests that the New York and the U.S. in general may be losing its relative attractiveness as a capital market place because of things like Sarbanes-Oxley. Can you comment a little further on that? Your interpretation of that chart?
Okay. There's so many different things going on that it's not as simple. Some people would like to, there are people who are advocates, for, deregulation, and they would love to say, gee, Sarbanes-Oxley has, been a bad thing, or Sarbanes-Oxley has been a good thing, whatever. It doesn't show up in these numbers in the way that makes a nice story for people, although, people will always try to take numbers and tell whatever story they would like to see. I think that as far as I can tell, the initial impact of Sarbanes-Oxley was, first of all, it was in reaction to some scandals, and so that's why sort of it came into being, and the enforcement of it was done in a way that was pretty tough. It was hard, it didn't give a lot. Now I think that the SEC has and the PBOC has the Public Accounting Standards Board have realized that, gee, we need to look at these things and make sure that they're not, all the requirements are reasonable and not overly complicated, so that it doesn't discourage companies from being public and it doesn't discourage foreign companies from being here. So as in the case of any new regulation, it needs to be fine-tuned going forward, and I think that process is well underway, and I think it'll help. At the same time, the question of the competitiveness of the U.S. markets relative to the rest of the world, I think the main thing that's driving that is that the rest of the world is really improving. If you go to other countries, you see that the capital markets in those countries are, becoming much more sophisticated and much more open. Not only are their equities markets much more sophisticated, but their fixed income markets, the whole regulatory process. It's just a matter of growing and becoming, a modernization. In a lot of countries, it's a question of modernizing. So what you're seeing is that, whereas if you look 20, 25 years ago, or even 100 years ago, people would say, gee, listing in the United States is like, it's this really big deal for a company. Now I think it's still a plus, but, it's not as much of a plus. Although I would say one of the interesting things is if you do the same charts, the same guys, it's Renee Stoltz and Andrew Caroli and Greg Deutsch, who have published this paper and who can update the numbers in it. They will, when they have done the same calculations for other stock exchanges, for example, the London market, according to their if you do the same chart, you don't see a premium there, because some stock exchanges have basically emphasized just becoming an efficient trading platform, but there's not the same, high regulatory standards that investors will actually pay a premium for and rely on. So it's a question of what you view as the role of your trading platform, or how do you actually attract companies. So I think companies coming to the U.S., they really, in some ways, they say, gee, all the Sarbanes-Oxley and so forth, it's a little bit of a nuisance, but in some ways it's why they're here too. It does help them out. It's a way for them to differentiate themselves from other companies that really can't meet those standards. So, any more questions? Yes, ma'am.
You're talking about massive consolidation of markets. These are electronically run. You haven't spoken to the security questions, the susceptibility to fraud or espionage in the electronics of these larger markets. All the eggs in one basket is somewhat of a risk.
The espionage and all that, I think you always have to ask yourself, I don't know the answer to your question, but I say, for sure, but you do have to ask yourself, have things, is it better than it was? Is it, making things electronic and all this? There clearly are risks in an electronic market, but there are also risks in a paper-based market as well. And if I was a SPY, I don't know which one I would rather operate in. I just don't know. So.
Perhaps is there a final question or so? We'll entertain that.
This one.
What do you think the threats of investment banks creating their own private exchanges will pose to the global stock exchanges and your commissions and fees?
Well, that's an excellent question. Probably one of the, you're referring to this in Europe, some of the investment banks are planning, at least, but based on reading the newspaper, they're planning something called Project Turquoise, which is to start their own stock exchange. And in fact, there are a number of platforms that are not stock exchanges, but whereby investors, either institutional investors or brokerage firms, can submit orders and can exchange that are not subject to the same regulation as a stock exchange. So in some ways, there are a number of these platforms that have grown through time, and and I could tell you a list off the top of my head, but it's not really a totally new phenomenon. I think that if there's always been what we call an upstairs market, an over-the-counter market in stocks, so that if somebody from one big brokerage wants to buy and sell a block of stocks, and he knows that buy or sell, and he knows that someone in another brokerage at their equity desk, they may call around and they may do a deal there. The only thing that's required is for them to report the trade publicly, so you may see it going across the tape, but in fact that trade didn't really take place on any public stock exchange. It really took place among the brokers. This is something that, and then, so you could look at the Operation Turquoise, or I don't know the details of Turquoise yet. I don't think they've come out, but there's a number of other kinds of electronic systems, basically, where that basically help this matching of investors. Some of them cater mostly to the institutional investors, so they can find counterparties among themselves and just sort of get away from Wall Street altogether. And then some of them are actually run by the brokerage firms. All these things are possible, and what they do is they form competition for the stock exchanges. And any stock exchange that creates a system knows that they not only have to compete against other stock exchanges which may be trading the same security, but they also have to trade against these. They also have competition against these off-exchange systems. So it's really just another set of mechanisms. I think ultimately, and now it's my own personal view, is that to the extent the trading is centralized, you're going to get more liquidity and better prices, tighter spreads. On the other hand, you don't want to create a monopoly, because then the monopolist, won't kind of keep up with things and won't be as efficient as a private sector. So it's kind of a dichotomy. On the one hand, you want as much economies of scale and liquidity in one place as possible. It makes it much easier for investors. On the other hand, you don't want to create artificial monopolies that lead to less efficient services for the investors. That's sort of the trade-off there. But I think you're always going to see back and forth between the one type of system and the other.
Well, thank you, Paul. With that, let's thank Dr. Bennett for coming down from New York to visit with us. Thank you.
The expectation